So there are people going, "Oh, this is just crazy. Gold's way overpriced. It normally it shouldn't. It always used to trade these." You're not supposed to say this, and it's normally deadly, but I think this is one of the exceptions. This time it's different. This is a whole difference of why gold has gone up than anything that we've talked about before. And let's face facts. When you have physical buying so greatly outweighing that the paper market, which used to basically control the price of gold, is gone, then as long as those physical reports continue and there's nothing that has changed on that, you have to assume the price can go higher over time.
Chinese insurance companies have been instructed to invest 1% of their assets into physical gold by the end of 2025, potentially absorbing 400 tons, around 8% of the annual global mine supply. This move underscores a growing global shift toward gold as a strategic reserve asset. PeterGrandich highlights that, unlike past rallies driven by paper speculation, the current surge is rooted in strong physical demand. This fundamental change led him to exit equities in 2021 and invest fully in physical gold. China is driving a surge in physical gold demand as the People's Bank of China, PBOC, sells U.S. Treasuries and reallocates reserves into gold. Bloomberg reports that the PBOC has issued new gold import quotas to meet rising institutional and retail demand, reinforcing the global de-dollarization trend. At the same time, the gold market faces a 900-ton annual supply deficit, expected to widen to 1,200 tons by late 2025. Since gold imported into China stays there, global supply shrinks further, prompting bullion banks to increase valuations by $500 to $1,200 based on tightening supply-demand dynamics. Reflecting this tightness, premiums on physical gold over COMEX futures reached 6.7% in April 2025, the highest since 1979. This widening gap reveals the extraordinary demand for physical metal compared to paper contracts and highlights the urgency among buyers to secure tangible holdings. Grandich notes that the current price movement has been unusually sharp and rapid. Even seasoned market watchers have been shocked by how quickly gold has appreciated. While a correction of around 10% may be expected, he points out whether it occurs at $3,300 or $4,300 is uncertain. Nevertheless, he remains confident that prices will increase significantly over the long term. Goldman Sachs has echoed this sentiment, accelerating its tail risk projection of $4,500 gold from 2026 to potentially as early as 2025. Their quantitative models, which factor in ongoing supply constraints, now support a price range of $4,200 to $4,800 in the near term. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, the big difference is that there's been huge physical demand. In 1980, it was a paper-driven market that drove gold up. In fact, all previous rallies. But this is unique. This is what made me sell all my stocks in 2021 and own gold and own it all the way through here, simply because tremendous physical demand that's been happening. And not only that 33 countries decided to repatriate their gold from London and New York to own it as well. So we knew something was transpiring. These central banks can't flip that. It isn't like they're buying it so they can make a profit and sell it one day to somebody else. So there's a huge change. I have a caution and a positive about gold. The caution is we moved very far, very fast. Even people like us that watch it every day are going, wow, I can't even believe it's here and all. So there's a 10% or so really sharp correction somewhere. But does it happen at 3,300 or 4,300? But I still think eventually prices would be higher. And here's what you have going for you. And please allow me, because this is very important. So I entered the business in the early 1980s, and the Dow had traded just between 700 and 1,000 for 12 years. In fact, they were so negative about stocks for the future that Business Week ran a famous front page called Equities Are Dead. And interest rates were 20%, inflation was double digit. Japan was taking over the world at that time, not China. Oil was going through the roof. Wall Street had no vision of the stocks ever going up. And this man that no one knew about came out and predicted 3,600 based on a technical analysis, again, no one knew about. His name was Robert Prechter Jr., called the Elliott Wave Theory, and he predicted this 3,600 on the Dow. And I remember vividly, even shows like Wall Street Week with Louis Rukeyser back then going, who is this guy? There's no way the Dow can go. It can't even get above 1,000. And the reason I tell that story is I'm not saying that gold's going to 40,000 too. But understand, just because something traded somewhere for a long period of time doesn't mean it always has to stay that way. So there are people going, oh, this is just crazy. Gold's way overpriced. these, you're not supposed to say this, and it's normally deadly, but I think this is one of the exceptions. This time it's different. This is a whole difference of why gold has gone up than anything that we've talked about before. And let's face facts. When you have physical buying so greatly outweighing that the paper market, which used to basically control the price of gold, is gone, then as long as those physical reports continue and there's nothing that has changed on that, you have to assume the price can go higher over time. Well, I've been saying this for weeks, ever since when Trump first, I don't even know if he was made president, but it was certainly after the election. He made a comment, something to the effect of, anybody that's in the BRICS, if you think you're going to trade, we're going to crush you. And I said, in fact, that statement, and of course, now what he's done, he's the single best marketing piece. Who's ever in charge of getting new members to the BRICS has to have a smile, because these are the type of things that actually going to chase people away. I make it very simple, Danielle. I said to my clientele and my followers a few days ago, if you believe that at the end of all of this, more people in the world are going to be more happy at the deal with the United States, then I'm not for you. If you believe they're going to be less likely to want to deal with the United States, then maybe you want to continue listening to me. And I believe net at the end of the day, that's how it's going to end up, that this will end up being more negative for the United States than positive.
The bond market faces renewed pressure amid expectations of a new Trump tax plan that could be enacted this summer, potentially adding trillions of dollars to an already mounting U.S. deficit. Recent volatility in bond yields, driven by fluctuating headlines on tariffs, suggests that elevated borrowing costs may persist in the near term, posing additional risks to economic stability. Following Trump's April 2nd tariff announcement, which many investors viewed as broader in scope than anticipated, there was a notable sell-off in U.S. government bonds. This move reflected growing unease about fiscal policy and its long-term economic implications. As investor confidence in U.S. economic resilience erodes, the likelihood of higher interest rates across both government and private lending markets increases, intensifying financial strain across sectors. PeterGrandich warns that the bond market has already signaled trouble. During recent overnight trading sessions, rising fears over the U.S. government's ability to meet interest obligations led to a sudden freeze in credit markets. According to Grandich, this type of systemic warning goes beyond what the Federal Reserve alone can remedy, underscoring the deeper risks embedded in current fiscal and monetary dynamics. Let's get back to the interview.
You know, what was interesting also that wasn't covered yesterday in that very same speech is how much he spoke about not only the deficits, but he also spoke about the real gorilla in the room that no one wants to talk about, and that's Medicare, Medicaid, and Social Security. And I was astounded that he would even bring that up and all. But he said what a lot of us have said for years. He finally said as far as a Fed governor could go. Yeah, I think if worse comes to worse and there's a complete meltdown, but I think he's prepared, and he's going to argue even today as we speak. The claims have not dropped off a lot. We saw a little break on the consumer number. I don't think that'll continue because I think this tariff stuff is going to raise inflation. But I don't think he has to be in a panic mode. And I say this, these people are human beings, and personalities inside help make their decisions. And I can see him waiting longer than he might have done under another president before supposedly, putting in a Fed put and all. And I'll also add this, Daniela, and I've said this for a few years now. I don't think the Fed has the power that it once had. I don't think it's reflected. They lost that through the word transitory. They really blew that move. And to hear Janet Yellen, who when I think historians look back, when they look back at this era and say, name the three top people that did more harm to America than anybody else, both as Fed governor, as secretary treasurer, she'll be in the top three. And yet she's out here throwing Trump under the bus too. So yeah, the Fed will eventually need to, especially if the market really accelerates to the downside. But I don't think they're prepared to jump in as fast as they might have otherwise if somebody else wasn't in the presidency. And I'll tell you this, Danielle, I wouldn't put it past Trump firing him. I mean, he's that type of person. So it's all, there's nothing really good out of this. That's why I keep this negative kind of defensive position, even though it doesn't help business, but it is what I think is the proper stance to take. Wanting something and the ability to do it could be two different things. Let's first address who it may be. There's been different opinions coming out from his closest in his team. Couple hours, one person says this and the market goes down. And then a few hours later, another member of his team says something different and the market goes up. I think his concern would be is even if he puts in a real special choice, He only has to look at one of his Supreme Court nominees who he thought was going to be clearly on his side and made recently a big vote against him. So I think he's going to try to pick somebody that he feels he has a personal relationship with or can have a personal relationship, even though there's supposed to be this independency. But here's the other problem. Again, the other big gorilla in the room. You can talk about lowering interest rates. It's great to say it and all, but deficits and debt just keeps going up. And despite all the initial talk and Doge was going to find, and maybe it has, trillions of dollars. And the bottom line is there's nothing happening in Congress where it has to happen in order to stop that runaway train. And that's where the bond market will start to get really, really concerned. We saw that a week or so ago in an overnight trading. People started to think, there may be a real problem here with the U.S. making interest payments. And boy, the credit market just seized up overnight. And, that goes beyond anything that the Fed can do. And I'll tell you this difference. Look what's happening in other key central banks now. Japan is having higher interest rates. Okay, yet other are lowering interest rates. And what did our dollar do? You know what I never thought I'd ever see, Danielle? It's my 42nd year. We saw one day the stock market cave, the dollar cave, the bond cave, and gold go up a lot. When the stock market caved, either bonds would rally and or the dollar would rally because those were the safe havens. So for your guest for these last few years who advised your listeners that gold was a safe haven and not the dollar and the bonds, they were proven correct.
As major global players continue shifting reserves away from traditional instruments and into tangible assets, the dynamics of the gold market are undergoing a profound transformation. Institutional mandates, aggressive central bank accumulation, and tightening physical availability reshape the pricing structure and investor behavior. Simultaneously, fiscal developments in the U.S. are adding stress to the bond market, amplifying the urgency for alternative strategies. These trends suggest a deeper recalibration of global financial priorities, with precious metals increasingly seen as hedges and foundational stores of value in an evolving monetary system. Could the rapid realignment toward physical gold signal a broader reset in global financial frameworks, and how might investors position themselves ahead of potential systemic shifts? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.